Do you know the old saying, there are two guarantees in life, death and taxes? Well, in today's video, we're going to be talking about those two guarantees. Now, on a regular basis, I see both retirees and advisors making poor tax decisions because they believe in a costly tax assumption that we're going to talk about in today's video. Now, what is that assumption? Assuming that taxes stop when you pass away and or not focusing on taxes after life. And I believe this is a critical mistake. Let me show you what I mean. On the screen, I have a common tax graph I see for many of the clients that we work with. This shows their estimated tax situation moving through time. It shows their estimated taxes owed moving through time. Now, the specifics of this person's situation isn't what's important here, but know that they have some sizable IRA balances, over $2 million, and a balance of Roth and taxable accounts. Now, in your situation, you might have less. Simply adjust the numbers, but the message in most situations is going to be very similar or the same. Now, we see right off the bat, this person will have some serious tax costs if they don't implement any tax strategies. This is simply looking at a withdrawal strategy of them taking taxable account first, traditional IRA second, and Roth accounts last. Now, these numbers are shown in inflation-adjusted terms, and we can see by 2040, this couple is pushed into various tax hurdles. All of this due to required distributions that they will be forced to take at age 75. And so given a tax graph that looks like this, we can see right off the bat that there is a place for conversions. Early in retirement, because they're living off of their taxable account, they are paying nothing in taxes. And ideally, we would like to start to fill in some of these income brackets with things like Roth conversions to pay less in taxes today in percentage terms than they will see down the road. Essentially, we want to smooth out this tax situation. But a common question I receive when we talk about Roth conversions is around the unknowns around life expectancy. For instance, we can see that if this couple lives into their 80s or 90s, this tax problem just keeps growing and getting worse. But what if they don't live that long? What if they pass away right here at the end of 2041? Now all of those tax troubles on the right side of this line should be completely eliminated, right? They aren't living long enough for those RMDs to keep pushing up their tax liability. And if this is the case, wouldn't that ruin a huge benefit we are gaining from the conversions? And the answer is no. Someone will have to pay that tax. The government doesn't give anything out without getting anything in return. When you contribute to your 401k while working, you get a tax break for what you contributed to that 401k. The idea here being they'll give you a tax break up front because they're going to claw back those taxes later on. And if you pass away with money still in your IRA, that money still has to be taxed. The government will still claw back that tax break they gave you. Now, let me just pause here to further drive something home around Roth conversions. So many questions or objections related to Roth conversions are about the tax cost today and how there is a time value to money. And if you pay taxes today, you have less working for you for the future, and so therefore you'll have less left at the end if you perform that conversion today. But if you understand the commutative property of multiplication, you understand that none of these objections are valid. Changing the order of factors does not change the product. Simply speaking, it all comes down to tax rates. The tax rate you are paying today versus the tax rate you would be avoiding down the road. Lower rate on the conversion than you'd pay later, and you will see tax savings. I have a simplistic proof shown on the screen. And as you can see, there is no time value of money on the taxes that you pay today. It's not as if you're giving something up today that you're hoping to recoup down the road. It all comes back to rates. Now, we could create a more complex example that varied returns through time, or had distributions happening on an annual basis, rather than all at once as we're showing with this simple proof. But understand, none of it matters. It doesn't change the outcome. It all comes down to rates. So this brings us to one of the most crucial and under-discussed Roth conversion variables, your heirs. You see, this couple has 2 kids, and if they passed away at the end of 2041, due to growth, we would estimate that they would pass on about $4 million in traditional IRA balances to the next generation. Their heirs don't get to just take this money out without any tax consequences. And they really don't have that much flexibility in deciding when to take that money out. They have 10 years to withdraw all of those traditional IRA funds, and they're going to be forced to take an annual required minimum of distribution, each of those given 10 years. Now, $4 million split between 2 children equals $2 million to each child. Now, if they have 10 years to take that money out, if we don't factor in any growth, they will have to take out approximately $200,000 each and every year as that required distribution. When this couple passed away, they did not eliminate their tax problem. Therefore, it didn't ruin the value of that Roth conversion. They passed that tax problem on to the next generation to deal with. Their son and daughter already have good jobs. Heck, they might even be in their peak earning years when this couple passes away. And so those $200,000 RMDs will be costly. And they may even be more costly than if this couple didn't pass away and they had to take their own RMDs. Now, I recently just met with a retiree that was in a similar situation to the one that we're describing in this video. But their current advisor recommended they shouldn't do Roth conversions because the break even would take too long. Their advisor estimated they would need to live into their 80s for that Roth conversion to make sense. But as we're showing in this presentation, the time it takes to break even doesn't matter. If they died before their personal break even, the tax liability and break even timeline passes to their heirs. Someone is paying the taxes. In fact, that break even might even move up sooner if they passed away. Now, we're going to be releasing additional videos talking about the latest RMD age increase and how it relates to your Roth conversion plan, but understand that this presentation relates to this latest change in RMD ages. As they push RMDs back to 73 or 75, depending on when you were born, it will give you additional years of relief from those mandated withdrawals. This will change the amount of taxes you owe while you're alive, but likely won't shift your Roth conversion strategy in a massive way. And a big reason for this is due to the next generation inheriting that tax problem. Yes, for many retirees, it will move back that break even slightly. But again, the amount of time it takes to hit that break even doesn't matter as much. The point is there is a break even. There is a tax benefit from you converting. Now understand that the tax implications of passing a tax problem on to the next generation will vary quite widely depending on your heir's tax situation. If your heirs are in a lower tax bracket because they have a lower paying job, let's say, then their required minimum distributions from those inherited accounts will likely cost less, and you will see a tax benefit from passing on something to the next generation in the form of those traditional IRA accounts. But if they have awesome paying jobs, they're in their peak earning years, or they're in retirement, those RMDs could get quite costly. In retirement, they might be trying to earn a healthcare subsidy. They might be trying to perform conversions of their own. And your inheritance and those RMDs from that inherited account may prevent this or push up their tax costs on any of the tax strategies they're trying to perform. And there are a bunch of smaller considerations here as well. For instance, where your heirs live relative to you is important. If your heirs live in a higher cost state and will see an added cost to taking out those inherited RMDs, then you will see a tax cost again from passing on to the next generation. If they live in a lower tax state, well then obviously the opposite is true. And also know that the number of heirs is also extremely important. If you're passing on a $4 million IRA to the next generation and you're passing it on to one person, that's going to be a lot higher tax cost than if you're passing it on to 4 heirs. Each of those heirs will take a smaller RMD and thus be able to spread out that tax cost across each of your heirs. Now, some of you may be watching this video thinking, who cares? Once I'm dead, I don't care what my taxes cost. I don't care what tax burden I pass to the next generation. They should be happy they're getting anything from me. And if you feel that way, that's fine. But I'm guessing if we peeled back your retirement plan and we peeled back the layers and decisions that you're making, I'm guessing there are some contradictions. The reason being is because by nature, there are a lot of decisions that we have to make in retirement that are long-term in nature. For instance, most Roth conversions are more of an optimization type of strategy rather than increasing your probability of success. A perfect example of this would be trying to avoid IRMA. Most people aren't subject to Medicare's IRMA because their income goal forces them into certain thresholds. A married couple would have to take more than $200,000 in income for them to naturally be pushed into those given IRMA zones. It's usually you're forced into IRMA because of rising RMDs. And so depending on your situation, these conversions don't necessarily make your retirement plan safer. Yes, they help avoid on an expense, but it's avoiding on an expense because you have too much growth, because you're forced to take too much income. And so giving up a portion of extra expenses when you're forced to take too much income does not necessarily improve your probability of success. You're already living in a situation that has some excess to it. Now, there are some conversion strategies that will increase your probability of success, but the majority of conversions are related to optimization. This is a 70-30, 80-20 type of situation. Optimization means you need to consider what happens when you die. If you're performing conversions in an optimization scenario and you don't care what happens to your taxes or your estate when you pass away, then that's a contradiction. And at the end of the day, this is still wealth that you worked hard for. Whether you focus on it or not, you are choosing where your hard-earned wealth goes. Choosing to not think about this variable, not think about a tax problem you're passing on to the next generation, means you are choosing, again, whether you know it or not, you are choosing to give more to Uncle Sam. Now understand, I'm not saying that everyone should have a plan to pass money on to the next generation. This is an extremely personal decision, and you can have a plan where you try to spend all of your wealth. Now, with the unknowns around longevity, that's going to be a very hard goal to precisely meet, but you could also give to charity instead. But to say that you don't care what happens when you pass away is a tough contradiction to plan for. Now, to wrap this all up and close the loop, as part of your tax strategy, you need to consider variables after life if you truly want to maximize tax savings and build the best Roth conversion plan. Within each of the accounts that you can pass on, the Roth account is king. It means passing on tax-free inheritances. Next up would be your taxable account, and this is second in line because you receive a step up in basis when you pass this account on to the next generation. But it ends up behind the Roth account because while you're growing this account, it can be a leaky bucket due to capital gains tax and dividend tax drags. And then finally, you have your IRA account. Now, I don't have an issue passing on a portion of that IRA account to the next generation because once again, they can spread out those RMDs across 10 years. And if it's not a large RMD, they can completely work that into their normal tax strategy. The point here is you just don't want to pass on too much. And luckily, this aligns with your tax strategy while still alive. Most families will benefit from using their taxable account within their Roth conversion strategy, using that taxable account to pay taxes and thus depleting some of that taxable account. Most families will want to leave a portion in their traditional IRA because they want to fill up the standard deduction, the 10% and 12% brackets with RMDs, and then maintain the majority of the wealth outside of this within their Roth account. And so understand that the heirs tax strategy and your personal tax strategy likely align pretty closely. The point of this video, however, is don't underestimate the tax burden that you can leave to the next generation. If you're underestimating that tax burden, you're likely underestimating the benefit from Roth conversions. Now, if you like this video and are looking to learn more about how to get more out of your estate plan, click on this video right here, where we talk about 3 unconventional estate planning strategies that can lead to 6-figure savings. Always remember, you don't need more money, you need a better plan. Thanks for watching.